Hi everyone, welcome back to liabilities. Today we are diving into one of the most important aspects in accounting, which is I break down into this balance sheet to financial transaction and three, effect of financial transaction on balance sheets. And also, we're going to buttress on the previous video topic, accounting equation or balance sheet equation. Balance sheet equation. At every point in time when a transaction takes place, it changes financial position of an organization. That is, the balance sheet figure changes. So how does this happen? That is what we are going to break down step by steps in this tutorial. So go along with us. Watch the video from the beginning to the end for you to understand how it happens. In simple language, the balance sheet equation, that is, the balance sheet at every point in time when a financial transaction takes place, balance sheets have to balance. For example, today, business open an account, pays money into bank as a capital to start the business, the transactions. Maybe 3 days to come, from the money the business paid into bank, withdraw the part of the money from it, buy a sample delivery van, as you're going to see it in the tutorial. So that also will change the position of the balance sheet. Every one of these transactions has double effect on the balance sheet. Let's say another day the business buy goods, it make payments. It has what? Two effect on the business also in the balance sheet. Another day, maybe the business buy goods on credit. Buy goods on credit. Goods is delivered to the company from the supplier, and the company receives the goods. It has two effects. Maybe another day, the company sold goods on credit. Every transaction has double effect, and this is what is popularly known as double entry. But what we are going to cover today is its effects on the balance sheet. How the figures in the balance sheet changes on the items that we have on the balance sheet. And what are those items? We have assets, we have liability, we have equity. So this transaction affects the balance sheet. This is what we are going to break down step by steps. So if you watch the video from the beginning to the end, you will never forget the effect of business transaction on balance sheet. What is balance sheet? Balance sheet is the set of financial is a set of financial statements. Financial statements which show the assets, liabilities, and the equity of a business, at any specific time in point, at any specific point in time, at any specific point in time. This is balance sheet. That is what? Balance sheet. And at every specific point in time, and at any specific point in time, a transaction takes place. There must be accounting equation. Which is assets. Accounting equation which is assets equal liabilities plus capital. At every point in time that transaction takes place, asset must be equal liability plus capital. That is what we are going to demonstrate today. So, and this is what balance sheet is: a set of financial transactions, financial statements. What are the financial statements in accounting? We have the financial position, which is balance sheet, P&L, statement of profit and loss, another comprehensive income. You have a statement of cash flow. You have a statement of changes in equity. You also have a notes to the accounts. So today we are driving into balance sheet, which is financial position, statement of financial position. This is the most important aspect in accounting. So balance sheet is a set of financial statements which shows the assets, liability, and equity of a business at any specific point in time. And at any specific point in time, and at this specific point in time, and at this specific point in time, the transaction takes place. There must be accounting equation, which is asset equal liability plus capital. So this is balance sheet. What do you understand by financial transaction? financial transaction. Like I said before, for more understanding of it, let me write it. Financial transaction. Financial transaction. In accounting, financial transaction, financial transaction. In accounting, is any financial event, is any financial event or occurrence, that changes the financial position, that changes the financial position of a business, which can be measured in monetary terms. And I gave example of this. Let me read it. Financial transaction is in accounting is any financial event or occurrence that changes the financial position of a business. Where does this changes take place? It takes place in what? In the balance sheet, which can be measured in monetary terms. And I give an example of it. Example: buying of goods in cash, selling of goods on credit. Purchasing. No. Buying and selling. Buying and selling of goods in cash. Buying of goods on credit. Okay, let me just say buying of goods in cash and on credit. Then selling of goods on credit, let me say on cash and on credit, and so on and so forth. Opening of bank accounts, that is starting a business. Let me say opening. No. Deposit of money. Deposits of money into bank for the purpose of business, of a business, so and so on and so forth. That is financial transaction. It has two effects on balance sheet, and that is, like I said, is popularly known as double entry. So these definitions cover these 2 and 3. The financial transaction and its effect on what? On balance. That is, it has two effects. On financial position, there must be credit or debit. And it has two effects on balance sheet also. Debit and credit of accounts elsewhere. Then in the balance sheet also it has two effects. Now, what is balance sheet equation? This has been dealt with in our previous video. There is balance sheet equation explained. Is there. Just web educate. You see there, web educate. Balance sheet equation is there. So we go ahead with the step-by-step calculation of this topic that we are covering today. The balance sheet equation and the effect of a business transaction on balance sheet. So we go with examples. And before I go further, I want to appeal to my subscribers, both the existing and the new one and the potential one, about my former videos and the past, which are not cleared. But of recent, the one that we started about 2 or 3 weeks ago, they are cleared. Unlike before, the one that I've been doing in the past, like say, one or 2 years plus. The one you'll be seeing now, they are cleared one. Please, sorry for the equipment used on those videos that are not clear. The one that I've just started about 3 weeks now, you find it helpful because the video are cleared. They are cleared, and by that I crave your indulgences to please subscribe to our channel so that I'll be able to continue to give you more helpful and valuable videos on accounting and other subjects like mathematics. I just introduced mathematics about 1 week ago, or even maybe day before yesterday. So you find all this video helpful. We continue with financial accounting, cost accounting, taxation, SFM, financial reporting, corporate reporting. Just you find the video helpful. But don't forget to share the video and subscribe to the channel. Share it to your friends. So I go on with the example here. The first transaction here that we have here is the introduction of capital. Intro. Let me put heading. Balance sheet equation and the effects of financial transaction on transactions on balance sheets. as you go along with this video, you will see that at every point in time, this example I just are like 7 examples. You find it helpful if you watch to the end the example that we are going to uncover today. And number one is introduction. Introduction of capital. Introduction of capital. Introduction of capital. On 1st January 2020, S. Ayodele, this is the owner of the business, started business, and deposits $100,000 into a bank account opened specially for the business, for the business. What is the effect of this on balance sheet? It has double effect. And if you must open the balance sheet, let's say, for you to prepare balance sheet, number one is to write the name S. Ayodele. Then you put balance sheet as at, this is not at the end of the what? At the end of the financial accounting period. But we are talking about what financial transaction here. So now, and I said that at every point in time, every financial transaction affects balance sheets in 2 ways. It's at point in time, as I defined it, as at, what is this date? 1st of January. Let me short it this way, 1st of January 2020. Then you rule. Now, one of it is what is assets. Assets. Let me make this non-current assets. Non-current assets. Sorry. We are not on current assets yet. What is the question? The question says, on 1st of January 2020, S. Ayodele started business and deposit 100,000 into a bank account. What is the meaning of this? That is, he started a business. He has not bought assets yet. But at every point in time, there must be an accounting equation. Asset equal capital, asset equal liability plus capital. What is happening now? This is the money deposited into what? Into bank. Say, especially for the business. It's a capital. Where does he deposit the money into? Into bank account. That is 2 effects. 2 effects, as we are saying. Just go along with us. And under the assets, we have not gotten to this to fixed assets yet. Here we are talking about what? About current assets. Current assets. Which is under it, we have inventory, we have receivables. Inventory is also known as stock. Receivable is also known as debtors. We have cash, At time you have cash in bank. Then here, where does he deposit the money? Bank, that is the cash at bank. Cash at bank, and let's just say this one. Say, what is the currency sign? Dollar. So how much does he deposit in the bank? That is 100,000 naira. So this is, in this case now, you know we say asset equal liability. Liabilities plus capital. But in this case, as you have seen, there is no liability in this case, isn't it? He deposited money in bank account. That means the money he has is what he used to buy the money he has is what he deposited into the bank. So there are two transactions. He deposited 100,000, that is the capital to start the business, into bank account. There is no liability yet. So what is the next? This is the current asset. Then we go to 1 is not here. 1, 2, 3. Asset, liability, and capital. One of these is not here. Which one is not here now? Which one is not here? It is liability. So the one that are here now is what? Asset and capital. Asset and capital. So that means asset equal. So where liability is not involved, asset is also what? Assets is also capital. It's also equal to capital. Isn't it? He has 100,000 and deposits into what? Into bank. That means the money he has in bank is equal to what he has as a capital. So there are two ways. You see, the asset is equal to capital, but when the business now goes on and started borrowing, like he cannot buy all the goods, he has the money to build or to buy a vehicle for the business, to rent a shop, but he doesn't have money to buy goods he needed for day-to-day transaction of the business. So he might source it from outsider, which is the thing that represents that is what we call liability. That represents that is what we call liability. So let me rub this off. It says either assets equal to liability plus capital, or assets equal capital. So let's go further. Let's go on. So we have, this is the current asset. Now there is no liability, but we have you see, as classification, like I told you in the last video, that what I just gave there in the accounting equation is just a sample of how asset and liability and capital takes place. But it's not it is not categorized how it is in the balance sheet. But today we are going to categorize it how it's supposed to be. So number one is what is asset. Then followed by, this is the total of the assets. That's the asset, which is what? Which is cash at bank. Then we have a liability. Liabilities and equity. So addition of the two have to give rise to what? To what we have in the asset. So we have, but in this case, there's no liability yet. We have what? Equity. Another name for equity, what is? Capital. Is capital. And how much does it deposit in the bank? And that is still 100, right? That is still $100. So you close the two. So you can see that what? This asset equal capital. Like I told you, it is either asset equal capital or asset equal liability plus capital. So we go further. That is the end of this financial transaction. This financial transaction, you deposited money into a bank account. It involves two entry. Let's not dive into double entry yet, so that the video will not be too long. But in the subsequent video, we'll be giving the double entry. But just what we are doing here is what accounting equation. There's no double entry here. Accounting equation. The account is equal at every point in time. I tell you honestly, if you watch the video to the end, you see that this step that I'm taking will help you to understand balance sheet very easily. And as you are advancing, you don't find accounting difficult, honestly. Just continue. Second example. Second example, and you continue to subscribe to us, continue to watch out for more video. As I've started, by the grace of God, I'm not going back again. The grace of God. Just continue to support us by subscribing to our channel and share our video. You find it helpful, honestly. You will not need much course. Once you go along with us, you understand financial accounting. Double entry. Sorry. Second example. What's second example? Second example, the purchase of an asset by check. The purchase of an asset by check. That's that one. Then what is now the transaction? On 3rd of January. On 3rd of January, let me short it this way, 2020, S. Ayodele, the owner of the business, S. Ayodele buys a delivery van. Sorry about this, my spelling. Delivery, either A or E, delivery van. Buys a delivery van for $50,000, paying by check. Paying by check. What is the effect of this? What is the transaction? What is the transaction effect here? Two things happen. What is number one? Like in the other one. Buy delivery vans. Abi? Purchase of delivery van. Purchase of the delivery van. And what happened? Two. Pay by check. Payment by check. This has an entry. This also has an entry in the balance sheet. Purchase of delivery van. So that means in the previous example there is no delivery van. Now we are going to include delivery van into what? Into the balance sheet. And also bank also have to be what? Has to be affected. So that is the two transaction that takes place, which must affect the financial position, which is what? Which is called balance sheet. So let's now continue with our former balance sheet. The former balance sheet, we have it as I say when you want to start balance sheet, we have to start with what? With the name of the owner of the business, maybe company, maybe an individual. S. Ayodele. Balance sheet as at, what is this date? 3rd of January. The first date is what? Is, I said, at every point in time, it affects balance sheet. That's effect of financial transaction on balance sheet. At 1st of January, what is the effect? We have a capital and what? And the capital and capital and what? And bank. Now we are going to have what? It also, we are going to add this transaction to what we have before. Balance sheet asset. Asset. 3rd of January 2020. These are balance sheets. Then, like I said, the categorizing, that is classification. Classification, I said categorizing, that's the same name. Whether categorization or what, or classification. So how do we classify the assets, liability, and equity under? We must start from assets. Assets, and we have a non-current assets. And what do you have under non-current assets here? We have a delivery fund. Delivery fund, because under asset must start from what? From non-current asset. Then now go to what? Current asset. In the former example, you have only current asset, but here you have both. So delivery van, you have a currency sign, which is, what is the amount of the delivery van you bought? $50,000. $50,000. Then it paid by what? By check. So that means assets that we have in bank has been what? Has been affected. He paid for delivery van. You know we have 100,000 there before. Abi? Now he paid. That means from the bank he paid what? So bank will be reduced. In the previous example you have 100,000 for the bank. So now under current asset. Under current assets, which is cash at bank. Cash at bank. It is what? We have 100,000 there before, but because he said he paid by check. So by check means that the money has what? The money back has reduced. So reduced to what? He withdrew 50,000 from 100, so the bank is going to reduce to, and the total of this gave what? 100,000. This is the under assets. Assets must be equal to liability plus capital. Liability has not come in yet, so what do you have now? So according to the classification, you must classify it like this. Liability, like I did in the first example, liabilities and equity. And what do you have here? No liability yet, but we have what? Capital or equity. You can call it capital, you can call it equity. Call it equity. And what is the amount? The amount he deposited in, the amount he has as capital. The amount he has as capital. Capital must remain capital. Capital, you don't touch capital. It must remain what? As capital. Start it. To be running the business. It's still 100 piece. It's still 100,000. Yeah, you withdraw from it. Yeah, you withdraw from it to buy delivery van. 50,000. But the capital is how the business is still what? It's still 100,000. Right? It's still $100,000. Right? You can see. Asset equal capital, or asset equal equity at every point in time. What do you mean by every point in time? This is the date. The asset must be equal to capital plus liability. But in this case, there's no liability yet. It is either asset equal capital, like I said, or asset equal liability plus capital. So this is the transactions effect of these examples. Let's go to number 3 example. Go to number 3 example. So you're going to find the video helpful if you watch all along and you continue to practice it this way. Like I'm doing it, balance sheet will not be hard for you. A lot of people find accounting difficult, but with these examples, accounting will not be difficult for you. Just know this first as what? As the starting point when you are preparing balance sheet. You have example 3. Example 3. The purchase of an asset. The purchase of an asset and incurring of liability. The purchase of an asset and the incurring of liabilities. You know, the second one, the second example is the purchase of an asset by check. In that case, liability is not coming, but in this case, liability is coming in. So asset plus B equal liability plus capital. What is the example? Say on 6th January, on 6th of January, let me stop it here, 2020, S. Ayodele buys goose for $10,000 from J Black and agrees to pay for them in 2 weeks. In 2 weeks time. On 6th of January, the purchase of an asset and incurring of liability. Then the example says on 6th of January 2020, S. Ayodele buys goods for $10,000 from J Black and agrees to pay for them in 2 weeks' time. What is the financial transaction concerning this? 1. Purchase of what? Of goods. 2. Purchase of goods on what? On credit. This will affect 2 things. It will affect stocks. It will affect stock because the purchase of goods. Whenever I hear purchase of goods, when goods are bought on credit, it's also represented by what? By stock or inventory. That is purchases in the double entry. But in the balance sheet, it is what? It is stock. The double entry is what? It is purchases. And the name of the person that is bought from will be entered. But in this case, the name of the person will not come to what? To the balance sheet, because it is summary of all the what? Of all the accounts. The balance that remains at the end of what? Of the period. But this is not the end of the period. This is the what? At every point in time. So this affect was stock because purchase of goods. Then, secondly, because the goods were purchased on credit, it affects what? That's the liability now comes. That is liability. You have this is a current asset. This affects current assets. And where exactly? That is under what? Under inventory or stock. Let's say stock for simplicity's sake. Then it is purchased on what? On credit. Because it's purchased on credit, agrees to pay later. That's now going to what? To current liabilities. And how do you classify current liability? Of this type, it is what? It is trade payables. Let me put it in a simpler, creditors. Another for creditor, another for stock is what? Is inventory. Another word for, according to IFRS now, creditor is known as what? As trade payables. And according to IFRS, stock formerly known as stock is now inventory. So two things happen here. So stock has to be affected, then creditor has to be what? Affected. That is, every transaction have two effects on balance sheets. So we now open the balance sheet again. Like I said, you start with the name S. Ayodele. Then from the previous example that we are having, is Ayodele, balance sheets as at, what is this date? I'm talking about financial transaction. Don't forget, what is this date? That is on 6th, balance sheet as at 6th of January 2020. Then, like I said, you have to start from what? From assets. And under assets, you already have a non-current assets. Non-current assets. And what do you have under non-current assets? You have a delivery van. You have delivery van. I'm not sure of this delivery van whether it's A yet, but because of the video, I only have time now to go and start checking the spelling. So if I'm correct or I'm wrong, just bear with me. What is the amount? What's the amount for the, say, no, the one that we have before? We are still having 50,000, right? Just back forward the video, or backward. The previous example, that's what we have there. Then, what do you have in the we have this is what we have in the non-current asset. Then under current asset, what do you have there? Current assets. We are just managing the budget. It's not big enough. Just bear with us. So current assets. Under current asset, what do you have there? Under current assets, we have in the previous example, we have a inventory. No. We have only bank. But in this case, we have inventory. We have inventory. Another name for it is what? Is stock. So how much now? Say he bought 10,000 from J Black and agrees to pay for them in 2 weeks' time. So, under our current asset, what do you have now? We have $10,000, right? You have $10,000, and under current asset, what do you see have again? You have cash at bank. And put this capital out. You have what? Cash at bank is 50,000, right? Because payment has not been made, we are going to see now that every transaction affects the balance sheet. So, in this case now, liability has come in. So we go to the next, liabilities. Liabilities and equity. In this case, liability has come in, but the first one that we have was under liability and equity is equity. And this is what? What is the capital? It's 100. It's $100,000. Then liability now comes in now, and that is the current liabilities. Current liabilities. How much is that? How do you represent current liabilities? It is called trade payables. Trade payable. And this is how much is this? This is the video is going to be a long one, but you understand it very well. How much is that? That is to be paid later is $10,000. It's $10,000. It's $10,000. 110. So that is, you can see that it's still the same, it's still equal. It's still equal. It's still equal. So you can see that assets, now this is not full classification of what? Of a balance sheet. Assets equal liability plus equity. This is the asset, this is the equity, this is the equity, and this is the liability. What is the asset there? You have a delivery van, you have a inventory, right? You have then under equity, you have a equity, which is the capital. You also have under liability, you have a trade payable. Are they not equal? They are equal. So that is that about that sample. Let's go further. The video is going to be a long one, but if you go along with us, you understand it properly in this way. Understand balance sheet, effect of financial transaction on balance sheet. Let's go to the fourth example. Let's go to the fourth example. You're going to find the video helpful to know that asset must be equal to liability plus capital at every point in time. And how do you open balance sheet, prepare balance sheet? That is what we are concerned with here. Fourth example. Let me clean this so that it's able to contain. Let me clean this. Example 4. Example 4. I have to be fast about it now. What's example 4? What's example 4? Example 4. This is sale of assets. On credit. On credit. So what is the example? You say on 10th January on 10th January 2020, goods which cost $3,000, on 10th January 2020, goods which cost $3,000 were sold to Kenny B. For the same amount. The money to be paid later. On 10th January 2020, goods which cost $3,000 were sold to Kelly B for the same amount. Which amount for 3,000? Goods which cost 3,000 was sold to Kelly B for $3,000. The money to be paid later. 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 So what is the effect of this? It has two effects. One, goods sold on credit. Now we have to affect what? The inventory. And it is sold on credit. This sold on credit has to affect the current asset also. The two effects here is under current assets. Under current assets. That is still under balance sheet. Then it affects what? Stock, which is inventory. With what amount? $3,000. And it affects what? Debtors also, because whoever that company sold goods to that does not make payment, that the money is to be collected in the future period, is known as debtor. Another word for the debtor is receivable. That is, the money is going to be receivable. And what is the amount? $3,000. If it is double entry, this is how it's going to be. But in this case, we have how much in the inventory before? We have 10,000. That means our inventory is going to remain what? 7,000. We deduct 3,000 from $10,000 that we have before. Because you may be wondering how does our inventory remain 7,000 when we open the balance sheet now. So because we have 10,000 there before, and we sold goods worth 3,000 to Big Kenny, right? So when we deduct from the goods that we have there, won't the value reduce? If we have goods of 10,000 and we sold 3,000, won't the value is going to reduce to what? To 7,000. That's what we are going to have in the what? In the inventory, and we're going to have additional asset, which is receivable, which is debtor. Okay, let's go and open the balance sheet. Let's go and open the balance sheet. So, like I told you, we are opening the balance sheet to start. The name of the owner of the business, owner of the business, and that is S. Ayodele. Then balance sheet. As at that point in time, balance sheet as at what date? 10th of January 2020. Like I told you, you start with the current asset. With assets. And which one do you start with there? Start with non-current asset, and that is delivery van, right? How much do you have in the delivery van? You have 50,000, right? This will not be reduced unless disposal takes place. Disposal does not take place. This should remain like this. Then what do you have? There is no more non-current asset. You have a current asset. Current assets. We start with inventory. Our inventory before is 10,000, but part of it is sold out. Remain what? It's going to remain 7,000. Going to remain 7,000. So it affects only the asset. It doesn't only affect only the asset. And which asset? Under the current asset. Then because you sold it out, you sold from 10,000, you sold 3,000 out. So 3,000 that we sold out is now you call what? But we did not receive the money. It's said to be paid later. So payments, who is going to make payments later? That is Kenny B. And that Kenny B is now our debtor. This we are going to, it is classified as what? Receivables or debtor. Receivable, or you call it debtor. You can call this stock. So you have a 3,000. You can see. Then we see a bank under current assets. Cash at bank. The video is going to be long, but you find it helpful. Prepare balance sheet, and this is what? How much do you have in the bank? You have 50,000 because you have not made payment from it. Then when you sum this up, it's going to give you 110, right? 110 for the asset. Then we go to liability and equity. Liabilities. And equity, then start with equity. Start with equity. What is the equity? That is $100,000. So, and you have a current, under equity you have this, you have a current liability. Current liabilities. You have a, what do you have there? You have a trade payable. Trade payable. And that is a 10,000, which represent the goods that SRD bought that has not been paid for. And what is the total value? That is 100. You can see assets equal liability plus capital $110. $110. Then let's quickly go to example 5. Example 5. At every point in time, that is how to prepare balance sheet. Its asset must be equal to liability plus capital. So what do you have here? We have a payment of liability. Payment, that is example 5. Example 5. Payment of liability. Payment of liability. Payment of liabilities. So the question, the example says, on 15th January 2020, S. Ayodele pays in check of $4,000 to J Black. On impact payment. Of the amount owing. You know, like I told you, like I said in the beginning of the video, that transaction involve buying of goods in cash or in credit, selling of goods in cash or in credit, then also payment for goods bought previously by what? By cash or in bank. Also opening of what? Of a deposit of money into bank for the opening of what? For capital, for the opening of what? Of the business. This is a payment for goods bought previously on credit. So we start by the preparation of what? Of the balance sheet. It starts, like I said, name of the owner, it may be company, it may be an individual, S. Ayodele. Then balance sheet. As at when? As at what date? 15th January 2020. You start with what? With non-current asset. Start with asset, and that is start with non-current assets. And what is that? You have only delivery van for now. And you have what is the amount? $50,000. We have not disposed from it. It still remains what? $50,000. Then you have current assets. You start with inventory because you already have inventory. And what is the amount? That's reduced to 7,000. You go to receivables. Another name for receivable is debtor. Another name for inventory is stock. What's receivable? That we have not received from our customer. That is 3,000. You also have a bank. What is cash at bank? What is still under current asset? Cash at bank. And this is $50,000, right? Because you have not made payments. Have we made payments? Payment of liability. So how much do we make? They pay, do you see? Okay, I did not analyze the financial transaction here. Before, let me do the analysis here. 1. of what? Of the amount previously owed to what? To J Black. From where? From what? That's from the bank. So this affects what? Cash. This affects current assets. Current assets. Where there? That is the amount that we have in the bank. How much are we going to pay now? We are paying $4,000. Right? To who? We are paying to what? To J Black. Who is J Black? That is our creditor. Who supplies us goods that we have not paid. The name that we use to represent that is called what? Creditors. So under current assets here, where exactly do you have this? You have it under current assets. You have it at cash, at bank. And how much is that? That's going to affect our bank. 4,000 is going to affect our bank. And we are having 50,000 there before. So if you remove 4,000 from 50,000, it's going to remain what? It's going to remain 46,000. So it's going to remain 46. So the new amount that we are going to have in our cash at bank is now what? 46,000, because we are going to make payment of 4,000 from 50,000. It's going to remain 46,000. So we are going to pay this 4,000 to whom? Pay to liabilities. Current liabilities. And what represents this? Under current liabilities, that is a trade payables. Trade pay. And how much? That is what's the amount? That is 4,000 naira. So our trade payables, what do you have there before? We have $10,000 there before. Right? So what is going to remain? It's going to remain, when you remove 4,000 from 10,000, it's going to remain $6,000, right? So the new amount that we are going to have now in our current asset is 46,000.